Folks, welcome to Sunday Night Stock Charts Live. Recording live from Long Island, New York. The Contrarian Trader, the most influential live stream at 6 p.m. Eastern Standard Time, recorded out of Huntington, New York. That is my opening salvo. All right, folks. Futures are open. Hope everybody had an awesome weekend. It's back to work. And I can't wait. All right. So we're going to be going over. I'm not a big fan of Kramer. Never have been. But he always has a saying that I like from time to time to steal from him. And that is, there's always a bull market somewhere. And you can extrapolate that. You could say, bull market could be short. If you short the market, it's a bull market, but in the right direction that you're on. But there are bull markets in areas that are setting up to move up higher. And there are areas where you can put money to work that are in real, serious bull markets. So, and they're not that far gone yet. You could still get on that train and enjoy the ride up higher. And we're going to talk about those charts relative to the S&P 500 in terms of performance. So tonight we're going to be going over a lot of ratio charts. Index A relative to S&P 500, and I'll show you how they're breaking out, meaning the alternative to the S&P 500. We're in a new dynamic. You're seeing long-term downtrends in certain sectors of the economy, the global economy, that are coming out of bear markets on a relative basis to the S&P 500 and breaking out into potentially new bull markets. So we're going to go to that. Now, let's begin with the futures price out. Yeah, you know what? Hold on a second. How rude of me. Let me first go to comments and say hello to people and make sure my audio is working properly rather than speaking 6 minutes because my volume is not working or I'm not sharing my screen, which I happen to be. Volume looks good. Let's say hello to people. Danny, welcome. Welcome. What the heck is that? A B. Okay. Okay. I like it. Thumbs up. Bullish. Mike. Hey, Bob and gang, LSCC, A-Night and Pins to and watch our earnings reaction. Okay. Michael, welcome to, and thanks for joining in. RB, welcome. Happy Sunday, Bob. Please cover QQQ and Apple from the short side. You bet. We are, well, yeah, we're still short of, Where's my notebook? Here it is. We're still short of the Qs. Not as short, but still short. I'm just looking at the E-minis here. They reversed off of the highs, and now they have gone green yet again. Our book is ready, and we are psyched. Psyched. Apple and Trip Qs. Apple. Q, if I'm spelling that correctly, and I think I am. Trader Isaac. Hello, Bob. Will the energy stocks stop going down this week? Good question. Oil reversed. Energy stocks did not. We'll take a look. XLE. Seymour Rivers. I was looking for you, my unofficial producer for audio, my sound technician, if you will. Thank you very much. Franklin, Bob and crew, evening, and hope everyone had a great weekend. Same to you, my friend. Reminder, Bob, I placed a few names for review in the members area. I do have them, and I will go over them. Mr. Jeff, there's a bull market in reverse ETF. Wise guy. Very, very, very true. Along the lines of what I was saying earlier. Love it. Bonnie Bean, where have you been? Where have you been? How dare you? We're worried sick. People think that we're tight like this. They come up to me, where's Bonnie Bean? I said, I don't know. Didn't tell me where she was. Great to have you back. Oil. Yes, we can go over USO. Denny. Hey, Denny. Good evening, Bob. QQQ for me also. Corey, we got it on the list. You are good to go, my friend. Uh, Dry October is something coming to it. Oh, yeah. It's Sober October. I guess ends on Tuesday, but I really don't drink during the week, so it's probably going to be next weekend. So yeah, I'll be definitely partaking in an adult beverage as who? God, I can't believe Rush Limbaugh used to say. I can't believe I forgot Rush's name for a moment there. Blasphemy, blasphemy. Love my Rush. Rest in peace. Peace. Okay. Let's get to it. Let me make sure all my other settings are good to go here, and we will have liftoff, and we will prepare for the new trading week. Folks, it's going to be all about levels this coming week. And if you're wondering where those levels are, what stocks we're watching, we did a live stream yesterday, and we went over a bunch of stocks. We talked about the value of levels in terms of surviving a bear market, or a correction, I should say. And I've added those symbols to our list here, Franklin. So you are good to go, my friend. So I did a video, a live stream yesterday. If you're not currently on our small account club list, that live stream is going private for various reasons in the new year. So link below. It's now called the small account club. Used to be called the 30-minute chart club. Now the small account club. And I'm trying to go live every Saturday now, 1 p.m. Eastern Standard Time. And we will talk about how we manage our portfolio. And yesterday was all about risk management in terms of a bear market and or correction. That doesn't mean that there aren't opportunities to be had in a counter trend rally to the upside. And we talked about those, but we don't want to stay long. Not at all. I mean, long in the trades, not long in position. I guess it's both in one and the same, to be honest with you. All right, let's get to it. I am completely caffeinated up. I am due espressos in now with a cafe americano. And let's get to it. All right, so we have the E-minis that have gapped up, and what they've done here this is the S&P 500 E-minis. They've gapped up, and I'm watching that 41.48 mark with great interest on a 15-minute chart. Why? Great question. The answer is that represents support, albeit very minor support. That 4,200 mark is real serious support. I think that we're going to rally up this week. We're going to retap that 4,200 mark, and God forbid they don't close it back above that mark going into next week. So the other thing I'm identifying here is the line in blue. That line in blue is your 21-period SMA simple moving average. They're trying to hold that line in the sand. Do they succeed? We don't know. We don't know. So our job is not to divine, like the hanging chads of the 2000 election, what the voter wanted or what the stock market's going to do. All we're going to do is we're going to do this. We're going to keep it very, very simple. If this, then that. So if this happens, then we do this. If that happens, then we do that, right? So we're not trying to outsmart the market. We're just looking for the market to tell us, what do we do? If you tell us to get long, we're going to go long. If you tell us to get short, we're going to go short. Simple as that. So we're going to pull back here, and we're going to go to a 4-hour chart. I want to take all my own private annotations off. No biases from last week get carried over into this week. We're going to take our crayon out, and we're going to do a very, very simple downtrend line. I thought that would be simple, but it was not. I'm going to try that again. Don't try this at home for you new traders out there. This is very complex and what's going on with my crayon here? Very complex and should be left only to the professionals. So what we're looking to do here is we're looking to see whether or not we are able to break out. And these are our macro trend lines for the week. Break out and above the upper band in green, or do we smash down below the lower band in red? Now, the thing to observe here and the value of us going over this 4-hour chart is because what is this pattern? This pattern is a declining wedge formation or a descending wedge formation. And when it's going down, typically, not always, but typically, it gets resolved to the upside. When it's rising, it usually gets amended to the downside. So the resolution that we would typically expect here is that we break out above the upper band of resistance. And again, the line in the sand going into this trading week, you may be saying this is last week's news. No, 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 it's not. It's this week's news. Do we challenge the 4,200 mark? And if we do we recapture it? That's the line in the sand. Now, if we do one of these numbers, we break out, all the bulls get raw, they get all excited. Oh, new bull market, we're back. We're back. No more sell-off. They're going to rally it up here. Then the question is, do we break out or do we break down? Simple as that. So what's my take here? I'm torn. I look at the weekly and I look at the monthly charts and I say that, you know what? I could easily see us moving lower. The however is that we're pretty beaten up. I can make the argument that going into November, which is seasonally the best month out of the year for equities, that we can have a rally. Now, would I like to have seen a bit more damage done to this market? Yeah, before I put money to work, sure. Am I going to get it? I think I probably will, but that's no guarantee. If we close out next Friday above 4,200, the probabilities of a continuation breakdown going into November dissipate dramatically. I cannot put that into air quotes quite enough. I cannot overemphasize what a psychological support level the 4,200 level is. In reality, it's not that much of a support level. We haven't spent all that much time challenging that level. We've basically shot through it, retested a couple of times, broke back above it. Not a lot of history there. What it is a narrative. It's a tale. It's a narrative spun in the mainstream media. 4,200, 4,200. They keep repeating it. That makes it reality. So we can't dismiss it. Sometimes the narrative just becomes reality, even though there's no basis for it. So we'll play the game. We'll play the game. So going into the new trading week, E-minis, descending wedge formation, 4-hour time frame, resistance up at 4,200. I think there's a very good chance that that's resistance level gets retested. So we'll take a look at the triple Qs. Now, the triple Qs closed up on Friday while the S&P 500 closed down. So was that the beginning of something on the Qs? Well, it wasn't an illustrious close. I'll tell you that right now. Let's clear off all of our old biases, our old drawings, get rid of them. Fresh new week. Sorry about that noise. Let's get our crayon out there. Again, don't try this at home. Only for professionals to do on your own. So you can see that we're very close to a breakout here on the NASDAQ 100. This is basically the futures version of the triple Qs. So here we have our upper band of resistance, and we're challenging it right now. Here's your lower band of support. So relative to the S&P 500, the Qs are far more along with their preparation for any rally than what is the S&P 500. So relative to the S&P 500, the NASDAQ 100, as has been the case for quite some time now, is showing relative strength. Looking at the Russell 2000, which I've been talking about quite vocally about wanting to perhaps get long. Let's clear off all this. Again, we don't want any biases carrying into the new trading week. What a sloppy chart. You can see how oversold this is. It's really oversold. Let's put it here. We're going to rally. I think we're going to rally. Russell 2000 futures up a little over a quarter percentage point. You know, really the what matters here are two other charts for a rally to occur. One is a 10-year yield. Let's check in with that. The 10-year yield appears to be pulling back. It certainly pulled back on Friday. That did not help the S&P 500 overall. It did help the Qs to a certain extent. They used that Amazon report as a reason to rally the Qs. And there was some basis in fact for that. It was a good earnings report, but they did have some guidance that was not great. So let's clear all this off. So the question here for us as we go into the new trading week is, you know, do we break down? And you could argue that on this 4-hour chart, you can see that these gray lines here, upper band and lower band, we've already broken down. So what we're doing is that we already have lower highs, right? So that's step one on the course to moving to lower lows, right? So do we have lower lows yet? Yeah, we do. We do have lower lows. You could argue though that we're in a consolidation range on the 10-year yield. I would not make the argument that we have broken down yet on the 10-year yield, especially when you take a look at a daily chart, which I went over with members, and that is in at worst right now, it's in a daily trading range. It has pulled back. I can see it breaking down, but I can also see it consolidating and then moving back up. Right. So on a weekly chart, what we're doing on that 10-year yield is that we hit the upper band of resistance. Must it drop down to retest the lower band of support? No, it doesn't have to. It could just pull back, consolidate, pause. That upper band each week that goes by keeps moving up higher without the yield moving up higher. And that gives the yield to move up higher yet again after a brief rest or a long rest. Who knows? So at current right now, we're seeing a 10-year yield, which is just simply taking a break. Now, when do we get a little bit more bearish on the 10-year yield? We get bearish on the 10-year yield and bullish on bonds on a break. I can't set an alert here. Yeah, there we go. On a breakdown below 4.98 on the 10-year. Right now, we're at 4.844. That's a reasonable pullback from where we were last week. We had a 5-handle last week on the 10-year yield. What else are we looking for? What else could influence the stock market in either direction? If it pulls back, equities could rally. If it rallies, the equities could pull back. That's the US dollar. And the dollar really showed some power last week. I mean, it was the pimp Mac Daddy of currencies. So you could see that on this chart here, again in gray, is that we have a bull flag setup on a 4-hour time frame. And we broke out above it here on Thursday, but then by Friday, we broke back down. That's not good. That's not bullish for the dollar. However, it still looks good. You cannot dismiss the dollar from breaking out yet again. Strong stocks tend to get stronger. The same thing holds true for currencies, especially currencies. They're more macro in nature. So I would have to say, even though we have a breakout point failure or a bull trap on a 4-hour chart, I still think the path of least resistance in the short term anyway remains to the upside for the US dollar. Therefore, it remains a thorn in the side along with the 10-year yield in the side of the equity markets. Trust me when I tell you, traders out there, professional traders out there, have one eye on the equities that they're trading, and the other eye is on their other monitors looking at the dollar, bond yields, and the options money flow. Options money flow. So the dollar looks good. It looks like it wants to break out higher. The however is that we had that breakout point failure on a 4-hour chart last week. Maybe it breaks down, maybe it doesn't. So it is a threat to the equity market. Moving on now. Let's go to, we did bond yields. We did the dollar. Since we're going to segue out of the dollar, let's rotate into commodities. Let's go to gold, spot gold price. Spot gold, wow. We began bull operations last week on spot gold by buying calls. We bought. We're going to dollar cost average into a long call position in spot gold, or I shouldn't say spot gold, the GLD. And we began that operation last Thursday. We are back above. We're opening above 2,000 the ounce. We were trading above it on, was it Thursday or Friday? It was on both Thursday and Friday. We traded above it. Actually, I'm sorry. What day is this here? The 20th. We hit it on the 20th. We hit it again. Yeah, we did it again on Friday, and we pulled back. So we have a long call position in on gold. We're going to be building that position from time to time whenever we get a pullback, and they give some opportunity. Folks, we are at the precipice of a major bull run in gold. So buckle up. This is a small market. Gold is a very small market. Silver, an even smaller one than gold, and everybody on the street is underweight. And once that money flow starts going into gold and silver, there is going to be a rip your face off rally like you've never seen before. And the Federal Reserve is going to hate it because the dollar is going to look, it's going to look worthless. It's going to look worthless because gold will be the talk of the town. Gold has been in a major bull run, all-time highs in every other major currency for the past 2-3 years, except for the US dollar. You don't hear that on the financial news. Moving on to silver. Before we leave gold, now we're up about over a 0.5 percentage point on gold. Silver is SI. Silver, we could head up to $23.89 the ounce easily. Looking very good here on silver. We're up right now 1.28% in the opening session here. Now, sticking with the commodity trade, let's move on over to oil, because oil had a good day on Friday. Not so good right now. We're down 1.75% on the session. It's not broken, but it's under threat. But it had a good day on Friday. Moving on to nat gas, of which we have a long position in. Wow, this is getting clubbed like a baby seal. 3.33%. I think what we're doing is we're filling the gap. All right. So that's actually a pretty good thing. Let's get that out of the way. And we may be looking to add to nat gas on this pullback this coming week. More on natural gas in a couple of minutes. We're going to be talking about it in greater detail, along with commodities. Moving on to just sticking with energy for a moment, home heating oil. That is down 1.42%. Good for the consumer. Let's take a look at, before we leave here, I want to take a look at the Japanese yen because it had a good close on Friday. We're at resistance right now. Let's take a look at euro. Euro is down slightly, but at support. All right, let's pull out to a weekly chart and we'll take a look at some ag names and, of course, live cattle futures. Now, corn, it's up in the pre-market, but last week was a horrible week. It broke down. Let's clear all this off. I'm in a very OCD way right now. I want my charts clean. So we broke down last week. This is last week's price action, not this week's price action. So that's rearview mirror stuff. We broke down last week on corn. That's a pretty nasty sell-off there. Soybeans. Let's clear all this off. Continuation rally last week, up and into resistance. Wheat. I think this is all a dead cat bounce. I think this gets resolved to the downside. That's a bold statement in an inflationary environment. But, as I always say, that weak stocks tend to get weaker. It goes for commodities as well. I mean, it's undeniable that we are in a bear market here. And there's no reason at current to get excited about this rally. The only excitement that I would have is if we broke support, and I would look to lean into the short side on wheat. Right now, I would avoid this. Now let's leave off our commodities with. They got to bring down the price of my New York strip. I enjoy my New York strip steak. Jonathan's in Huntington makes an awesome New York strip. Great fries that go along with it. Great side sauces. Awesome, awesome, awesome. And broke down last week. Not a big macro breakdown, but it broke trend. Momentum broke. It didn't break trend. I shouldn't say that. The momentum kind of had a little bit of air taken out of it. What we need to see is a break below this lower band of support here. That's the macro view. This is only a secondary downtrend line. These Bill Gates wackos building artificial meat plants. Tyson Foods doing it now too. So hopefully we get a break here on cattle futures and we get only real beef on our plates. New York strip, awesome. Medium to almost rare, I like it. I'm sure you're very, very interested in that. All right, let's did I cover everything? I think I did. Yeah. I think we're good here. Let's just check back in real quick with the E-minis, see if anything's changed. No, we're looking good here. Now we're up nearly 1/3%. We were higher. We're looking good. So E-minis looking okay going into the new trading week. I shouldn't just say E-minis. The equity complex is looking pretty good. Let's take a look at our topics for what the heck happened here. Oh, don't tell me they did this to me. Okay, let's get to it. I'm going to pin this to my timeline. There we go. On Twitter. Dad, if socialism doesn't work, why do people still support it? Because they don't work either, son. Love that. Love that. So the reason why I start off with that is that you're going to see a lot of distractions out there, folks. I don't minimize attacks on our soldiers. I love our soldiers, love our military. I do not want to see anybody get hurt. But this is a great tool for the regime, the Biden regime, to keep people distracted. They want me coming on here to talk to you about this. This is what they want. They don't want me to talk about what we're about to talk about. They want you to have hatred for what's going on over in Syria, over in Israel, over in Palestine. It's horrible. What's going on in the Ukraine is horrible. It's a sideshow. It's a distraction. We're not going to talk about it. We're here to make money. And for us to pay attention to this and allow it to influence our trading decisions is amateurish. This is a sideshow. And frankly, how we did not expect a counterattack out of the Russians through Syria using Iran is beyond me. So it's payback time. This is only going to get worse. So let's not. The Chrome is crashing on me. All my tabs, I can see it crashing on me. All right. Let's move on. Let's not get lost here. So the people that are falling for all this as a narrative, as a reason why to hate for no reason, to argue with other people that you don't even know for no reason, to not have Thanksgiving dinner with family because you have a disagreement for no reason, these are the people. Average composite ACT score dropping like a rock, while you have other major economies, India, China, getting ready to eat our lunch in terms of education. This is us here in the United States. And this is this status of our future leaders. Tom Keene of Bloomberg, who I rarely agree with, got to agree with him here, a huge deal. This is a massive deal. This is generational. The fact that our ACT scores are declining like a rock. Going into the new trading week, economic calendar. I haven't even looked at this yet. The 31st. Wow, this is a jobs week again? Holy cow, that week, the month flew. Tuesday, employment cost index. That's important. Wednesday, ADP. That's the precursor to the Pimp Mac Daddy of them all. Fridays, non-farm payrolls. Watch out for average hours worked and average hourly earnings. Very, very important. We're going to have ISM manufacturing come out. Do we get services as well? I don't see services here. I'm surprised. They usually report about the same time. Okay, no services this week. Thursday, initial jobs claims. We get that every week. Again, U.S. unit labor costs. 2 reports prior to non-farm payrolls. Odd. Friday, non-farm payrolls coming out. Again, average hourly earnings, you want to watch out for that. Also, average hours worked. Oh, we get the services sector. They report on Friday at 10 a.m. So watch for a read above 50. That's a sign of expansion. A read below 50 is a sign of contraction. The same thing holds true for manufacturing, but manufacturing's been in a contraction for quite some time. However, last month, it did fill the gap a bit. Now, you would expect that with the so-called 4.9% GDP print for last quarter, which I don't believe for a second, you would expect that manufacturing would be in positive territory. God forbid that happens. That may validate some of the accuracy of their economic reporting. But this is the garbage that we get out of the regime nowadays. So I don't believe that report for one solitary second. What did yields do when that report came out? They dropped. Yields dropped, then ultimately rebounded. Chrome, really, they got to do an update here. All right, the CME watch tool. This has been wonky all weekend long. I did the live stream. I prepped for the live stream, and I was talking about how they were pricing in a rate cut for November, which wasn't there on Friday. And then I did a refresh because this changes so frequently, and it was actually gone. I look like an idiot, but now it's back. They have a 2.6% probability of a rate cut in November. It's not going to happen, obviously. We're not going to get a rate hike this coming week. Then I skipped right over it. FOMC meeting this week. December, 2.1% probability of a rate cut. This was not there midweek last week. So you get a GDP print that comes out at 4.9%. All of a sudden, you start getting forecasts for rate cuts. What's that all about? That's pretty much counterintuitive as it gets. But the probability of no rate cut is still up there as the high probability. Now we start looking at January. Because remember, the market's going to do what the forecast on the CME watch tool is forecasting. And again, you're seeing no rate hike in January. So what it looks like is that we're not going to get any rate hikes for quite a while. So that pause is probably on the table for a while. They're going to have to allow the market to digest all of these rate hikes and then say, okay, where to from here? But what is that going to allow gold to do? It's going up. It's going up. Because what the Federal Reserve is now saying is that we're done. And now you're actually starting to see rate cuts get factored in. And brother, they start cutting rates, you're going to see gold go ripping through the ceiling. You're going to see the dollar drop like a rock. Shiller PE ratio as we move into the new trading week, 28.14. The first Sunday in quite a while that I've been able to say that we have a 28 handle, which is still historically very, very high on the S&P 500. Now, we want to show both sides of the coin. I don't want to come on here only showing you doom and gloom. I'm a bigger believer in rear view mirror fact-based PE levels, PE ratios. Now, a lot of people, they focus in on the forward-looking. Now, there's too many variables that could change this, and I'm not a big believer in using forward-looking multiples, but it's out there, and to be fair, we want to talk about it. We want to give both sides of the coin, both sides of the story. We want to be fair and balanced here. So the forward-looking 12-month PE ratio for the S&P 500 is 17.1, is below the 5-year average of 18.7 and below the 10-year average of 17.5. That's newsworthy. I could not report this. So if you believe in using forward-looking guidance, okay, fine. This is good news for you. I'm not in that camp per se, but I need to respect those that are and say, okay, if I am a net short of this market, I had better respect the fact that this metric is where it is. And I better not get too complacent because this could cause a problem for me and I could be at risk for a risk face-off rally. Now, we're not net short. We have a lot of capital. We're less short now than what we were going into the trading week last week and 2 weeks ago. We no longer have put options on the triple Qs. So this is Tom the Trader One off of Twitter. He posts some good stuff. I don't generally agree with him on a lot of stuff, but because he's usually very bullish no matter what the scenario is. But I do agree with him on this. I give props to where it's deserved. So S&P 500 thoughts. Don't get lost in the fear. Valid. Very, very valid. As a contrarian, I'm very, very wary of getting lost in a narrative, especially in a bull market. The market is fearful and on the way to a bottom. The narrative will be filled with reasons why it shouldn't stop. True. These fund managers are lightening up on long positions like there's no tomorrow. Now, do they want a rally? No, not at all. They want the market to go lower so they don't look like idiots having to buy in back in at a higher price. So the last thing they want is to be selling and all of a sudden the markets go back up. They look pretty foolish because then they're chasing the market. Active fund managers have clients positioned with the least exposure since October of 2022 low. Fear has undeniably set in. Yes and no. Using the put-call ratio, using the Bulls-Bear sentiment survey, we are not at the extremes where we were a couple of months ago. So I'm not completely in his camp. I get where he's going. What he's using here is the CNN, and as soon as they say CNN to me, I'm just like, I don't put much faith into it whatsoever. The fear greed index they put out, that chart with the tachometer, fear, greed, medium. It's on the low end. It's approaching fear, if not at fear. Extreme fear and minimal exposure is a combination that has preceded all meaningful advances. Well, yeah. Well, it was only a month and a half ago, we were at very, very fearful levels and we had a rally and now we're rolled back over again. So I'm not saying it's going to be a very, very meaningful meaning. We're going to new all-time highs. Maybe we will, maybe we won't. But could we have a counter trend rally? Yeah, we can, up to that 4,200 mark at least. I remain an advocate for the 3950 to 4100 area as a candidate for a correction base. This is a range for my portfolio to buy fear. I won't say no to that because I haven't looked at those levels quite yet. I'm looking for a counter trend rally up to 4,200 to see whether or not we'll recapture. If we fail, then we'll take a look at where our next support levels are at. So that is Tom the Trader One on Twitter. Sorry about this having to reboot. Earnings, I'm cut out of sequence here. Another big week going into the new trading week. We get Mickey D's tomorrow. Pins on Monday after the close. Pfizer, which to me is a completely uninvestable company along with Moderna. And look at their stock prices. I've been saying that for months now. And if you're long of that stock, it has not paid off quite well. We get CAT coming out on Tuesday morning. That's more of a global play, a global macro play. Watch that report. Very, very important. BP comes out. Energy stock, Marathon Petroleum coming out. AMD after the close on Tuesday. That's a biggie for SMH. What else do we got? Wednesday, Generac. That's a good little company. After the close on Friday, PayPal. That stock has just been decimated. Qualcomm comes out after the close on Wednesday. Airbnb. Thursday, Shopify pre-market. Moderna, another uninvestable stock. Barrick Gold, watch out for that one. Penn Gaming comes out pre-market. After the close, we get the Pimp Mac Daddy of them all. Apple. Block, formerly known as Square, comes out. DraftKings, Carvana. Starbucks comes out. Coinbase comes out. Cloudflare, good little company. And then on Friday, not much. Not much at all. So it's a busy week for earnings. We're starting to see the smaller players come out now and report earnings. Less of the big macro names that we were getting from last week, but still some very, very serious names. Palantir comes out this week as well. Okay, so time to start thinking quadrillions as there's zero fiscal restraint in Washington, D.C. So I can go into this. I'm actually running late on time here. Uh, but I'm going to show you what basically there's no fiscal austerity whatsoever. Forget austerity. Austerity. There's no fiscal self-awareness in Washington, D.C. The Uniparty is still in charge. And the Uniparty is both basically Republicans and Democrats, very little difference whatsoever. And they love to spend. That's their power. So ultimately, this is going to be our demise, is the fact that they are printing money and spending it overseas, not in infrastructure, spending it overseas on war. I got to skip a lot of this if I want to get to these watch stocks. Yield curve, we've spoken about this for months now, and now you're seeing a lot more tweets about it. Buckle up. This yield curve is steepening. It was down a basis point last week, but the trend is clearly up. Housing prices. I think that this is they're at the lows of the year. I think that you're seeing a little bit of fear enter the market. I think that the narrative is trying to get spun that home prices are falling, trying to get people to sell out of their low interest rate mortgages. That'll help the banks that are holding those mortgages because they can get rid of them. They don't want them on their books, not making any money on them. So I think that's what's happening here. I smell a rat. That's basically what I'm sensing here, is they're trying to spook people out of their mortgages. And I don't think it'll last. I think that we have a crisis in the commercial real estate market. Is residential real estate overpriced? Probably, but it's due to the fact that people are now locked into very, very low interest rates. They're never going to see these rates again. Why would they sell? Also, you've had a flight from the cities into the suburbs because of the horrible policies of the blue cities. So there's a reason for home prices moving up the way they have. It's not without cause. So I'm suspect of this. I don't necessarily agree that we're seeing a housing crisis. I could be proved wrong here, but this is nowhere near 2007, 2008, 2009 problems. Even the banks, the money center banks, in terms of their mortgage quality portfolios, have that kind of exposure. Job openings is a reliable indicator for future unemployment rate. Job openings have collapsed, indicating that unemployment rate is likely to follow. True. Bank stocks. These are the regional bank stocks. They are now down below the lows of when the crisis began. I mean, the regional banks are just falling apart here. What's wrong with the regional banks? We know what it is. It's the laddering of their portfolios to very, very low interest rates. They have horrible risk management. The Federal Reserve, who forced them to buy these bonds, did not require them to have proper risk management. Now these banks are suckling at the teat of the Federal Reserve to keep themselves alive. They're also exposed to the commercial real estate market, which is just going under. So now they're on life support. So now we go to the bullish segment of our show. Here's a chart of the S&P 500. This is like the segue, the tease into the bullish portion. So what we have here on the S&P 500 monthly chart is what I believe to be a big, big double top. Are we broken? No, we'll be broken if we break down below 3,491 spot 58. We're a long way away from there. Unless, of course, we crash, which is not entirely out of the realm of possibility. Now, RSI in a downtrend. We have what? 2 trading days left to go in the month. So we're not seeing a bullish divergence. RSI is simply validating price, and it's not looking good. The Dow transports falling off of a cliff. We are down nearly 10% in a single month on the Dow transports. Something's broken. So that 4.9% GDP read from last week for last quarter, I got to call out BS on that GDP read. So why are we now bullish? Where's the bullish case come in here? Well, let's start off with the actually, I'm not ready for that yet. I skipped a chart. Dow Jones US Containers and Packaging Index. We spoke about this the other day. We are holding the lower band of support. If we break this macro trend line, buckle up. Buckle up. We're going into lockup in the global economy. Something's very, very wrong. This is a major leading indicator, along with the Dow transports, that there's something very, very wrong out there, and you don't need packaging. If you don't need packaging, it means you're not selling stuff. Now, copper is breaking down. Is there a reason to be optimistic on a equity growth point of view? No, zero, nada, no reason whatsoever. No reason whatsoever. However, is there an area where we could put capital to work and outperform the S&P 500? Yes. Let's get to it. What you're looking at here, folks, is a ratio chart. What's a ratio chart? All it's doing is showing, in this case here, the S&P commodity index relative to the S&P 500. So what this chart is measuring is the strength of the commodity index relative to the S&P 500. So we're going up. So what that's telling us is that the commodity index relative to the S&P 500 is outperforming the S&P 500. You may be saying, by how much, Bob? I'm glad you asked. We are outperforming the S&P 500 by over a percentage point in a month. In a month. So you're up on the month relative to the S&P 500 if you're fully invested in the commodity basket. Not all commodities, because we just looked at copper, and that's not doing so well. It's outperforming the S&P 500, because I think the S&P 500 is down 3% and change, nearly 4% on the month. Now, taking a look at another chart here is the Dow Jones Mining Index. Now, the Dow Jones Mining Index, this is not a ratio chart. We're going to go to a ratio chart in a moment. The Dow Jones Mining Index is up on the month. We are at the apex of a triangle formation. This is either breaking out or breaking down very, very soon. Now, looking at it on a relative basis, again, Dow Jones Manufacturing relative to the S&P 500, we are up. No breakout yet, but we are up. And when you take a look at this chart, going back on a quarterly time frame, if they give us all that much data, I have not looked at this. Folks, we're getting ready for a major, major bull run here, and we are just at the beginning of it. That's the good news. So, as I preached yesterday on our live stream, our small account club live stream, again, link below. If you're not currently on that list, we're going to be going private live streams in January 24. So get on that list, link below. If you're able to, take a look at that video and just look at the bullet points I put out on how to survive a correction / bear market. It's all about liquidity. It's all about staying off margin and having capital at your disposal to take advantage of great, great opportunities when nobody else is talking about them. Nobody's talking about this on CNBC. They won't. They're forbidden. It's verboten to talk about it because all their sponsors are loading up. They're beginning to back up the truck. You saw gold is breaking out right now. They're beginning to back up the truck. The last thing they want CNBC to be doing is saying, look at this. Look at this. On a relative basis, we have a massive, massive W formation forming on the Dow Jones Mining Index, on the commodity basket, going back a quarterly view. Actually, sorry, wrong chart. The commodity index, I apologize. Commodity index going back a very, very long time. Again, quarterly view. This is the 1,000-foot view, 10,000-foot view of the battlefield. Nobody's talking about this. Here, let's get our crayon out. Let's have fun. We're in breaking news right now. Nobody on CNBC is going to talk about this. Here we go. It's not what's going to happen with the commodity index. It's what's already happened. We are in a new bull market, and nobody wants to talk about it. We broke out Q1 of 2022, quarterly chart. The quarters fly by, but we pulled back, retested the breakout point. Now we're moving up higher, and this is relative to the S&P 500. You want to buy the S&P 500 looking like this? Double top, lower lows, or do you want to back up the truck on commodities, putting in higher lows and higher highs? You need more evidence that we're in a new paradigm. This is a paradigm shift. We have only 2 trading days left to go in the month. And here's gold. This is what you call a bullish engulfing. I have a 5-part video tutorial, my top 5 favorite candlestick patterns. This is one of them, link below, free. This is the Pimp Mac Daddy of all breakouts that's setting up here. I began this commentary saying that we are buying simple 1-lot contracts going out over a year on the GLD. We put money to work on Friday selling puts on NUGT. I plan on buying GDXJ this week. We already own it. We plan on adding more this week. So I'm being forced to the plate. I've wanted a more serious pullback here. We may get it on the mining stocks. That's why I'm being so cautious and not jumping with both feet. But I think that we are going to get money flow going into commodities. And if you're not looking here, you're making a mistake, I believe, going out several years. You're going to be doing a look back and saying, oh my God, look at this. Now, the quiet bull market that's been going on is Bitcoin. Bitcoin monthly chart is up 28.44%. It gets better. On the year, Bitcoin is up nearly 110%. What's going on out there? Why is gold and Bitcoin breaking out? Why? It's simple. We have debt that cannot be paid back. We have a government that it's like a drunken sailor navigating a tanker full of oil into an iceberg. It's not going to end well. There are going to be bodies all over the place on this one. What's coming is going to be horrific. The big money knows it. They're buying farmland. They're buying real estate. They're buying Bitcoin. They're buying gold. They're buying other commodities. They know what's going to happen here. We want to be the smart money. We want to know what the big money is doing. And they haven't even really begun in earnest yet on gold. They haven't begun yet in earnest on silver, because if they had, those small markets with a lot of money chasing into them, boom, are going to explode. Time to consider, consult your financial advisor, time to consider dollar cost averaging into these names right now. On a relative basis, what's Bitcoin doing versus the S&P 500? Folks, look at this. I don't make this up. Look at this breakout. It's clear and defined. The markets are speaking volumes. They're saying, get out of the S&P 500. Yields are too high. They're going to go up higher. They need rate cuts to survive. And it doesn't look like those rate cuts are coming very soon. We already went over the CME watch tool. There are little blemishes of potential rate cuts here and there, but not for the next quarter at least. So Bitcoin breaking out. Now, hopefully, as we go into the new month, we get a shakeout here. And I want to spend a moment here because it's worth it. Because I dollar cost average in every Monday. So I'm going to be buying high here, but that's okay because you only buy a little bit when it's high. So what I'd like to do is put more money to work, hopefully next month when we get a retracement. If we get a retracement, back down to do a retest of support. Now, what else is out there that we need to start looking at? You're going to laugh, but utilities. Why? The vast majority, the vast amount of rate hikes are in the rearview mirror. They've already happened. We cannot afford, as a country, to have debt payments equivalent to our defense spending. Something's got to give. So if you have a index like the Dow Jones Utility Average, which trades inversely of the 10-year yield, meaning 10-year yield goes up, that means utilities go down. Why? It's because utilities are capital intensive. They're always going into the bond market to issue new bonds for maintenance, expansion, whatever. So they compete with treasuries, which pay a higher yield and are perceived to be less of a risk than utility debt. So utilities have to pay a higher yield on their debt relative to treasuries. Simple as that. So if yields are going up, utilities go down. That's the inverse correlation. But what the utilities are telling you now, this is again a monthly chart. You have the S&P 500 down nearly 4% on the month, but the utilities are down only 4.5%. So what are the utilities telling you? Even though the 10-year yield is up on the month, they're telling you that the market is a forward-looking mechanism. They're saying the Fed's done here. If they go into rate cut mode, that helps the bottom line of the utilities because they don't have to pay out as much in interest. They can pay out less. And people are going to be chasing yield. And these are dividend payers. So people will take advantage of utilities because A, upside capital appreciation along with a respectable dividend. What's wrong with that? So relative to the S&P 500, again, monthly chart, on the month, the utilities are up 3.68%. So let's put that into context. Investor 1 owns 100 shares of SPY. Investor 2 owns 100 shares of XLU, assumption being they're priced the same amount. Well, Investor B, or Investor 2, what did I say? Is up on the month 3.68% relative to the other investor holding the S&P 500 who is down on the month. Other chart. we're long of nat gas, which is down horrible right now in the pre-market, but I like it because we're going to fill that gap. Natural gas. Again, it's not what may happen. It's what is happening on a relative basis to the S&P 500. Natural gas on the month, folks, on the month is up nearly 24% relative to the S&P 500. Think about it. And we're long here. So again, there's always a bull market somewhere. I'll take that from Kramer. I'll give him his credit, whoever he stole that from, but I'll give him his due. There is a bull market here. It's not in equities. It is in certain commodities. Let's do some chart equals. Let's go back first to comments. I like medium well. You talk about my New York strip. Little bit. There you go. I'm with you. My daughter's like my mother. She's like rare. Beyond Meat. Oh my God. That company. What's that stock doing? Is that still in free fall? Come on. You could do it. That's down. Wow. Down almost 38% on the month. I'm so shocked. I'm so shocked that nobody wants to eat that slop. Hey Bob, would you start building positions on Macy's? No retail, no airlines, no. I don't mean to just be a wet rag. I don't want to be that, and I'm sorry if I am. I hate anything that has to do with the consumer. The consumer is broken. Consumer debt is ripping through the ceiling, and earnings are going down on a relative basis. The banks are going to get hurt. Consumers are going to be tapped out because their credit lines are going to get cut, and that's going to be the end of the consumer. Avoid. Daisy Wazy, been a while. How you been? Dumb people are easy to control. Correct. Very much so. And that's what they're hoping for. Don't worry, our future leaders won't be American anyway. True. Jody, welcome. Everybody loves Jody. Hi, Jody. Happy Halloween. She's going to be more popular than I am. Hi, Bob. The contrarian lover of jack-o'-lanterns be handing out the finest chocolate to trick-or-treaters Tuesday, Halloween? I will be, yes. Yes, I'm a big fan of the trick-or-treaters. I don't want to see toilet paper up in my trees, so I respect those young lads. I make sure, hell, I'll give them a beer if they don't egg my house. Mike Santoli, good guy, likes his charts for CNBC viewers. I haven't watched Santoli on CNBC much. I don't watch that. I just don't watch the program. Fibonacci charts for GNX. I'm not a big Fibonacci guy. I got to tell you, Mike, I'm sorry. I'm not a big Fib guy. I like real hard and fast historical support levels. If I don't have those support levels, I'll revert to the Fibonacci's, but for the most part, I'm not big into them. Pimp Mac Daddy. XRP. I don't track XRP. I don't think you could buy it here in the States unless they've lifted that ban. I haven't looked at it, so I'm not. No, I don't know enough about it. I think you could buy it over in Europe, but not here in the States. Spending. That's right. I was a drunken sailor. I didn't spend like the government. Smart. I think that's the buoy right now for Bitcoin. Once BlackRock gets that ETF approved, and they will, Bitcoin is going to go skyrocketing. I have an $80,000 price target on Bitcoin, and a lot of people laugh at that, but we were at 69,000. That was months ago, so it's not hard to believe that if we make new higher highs, well, the next line in the sand is going to be up at around 80,000. Correct. Dividends, utilities, correct. I'm bullish, Barrick Gold, bullish on the gold mining stocks, but you got a dollar cost average in. The reason I say that is that the gold stocks are not like gold. If we get a real nasty sell-off in the market circa 2020, those gold stocks are going to go down too. So I've been very, very stubborn about getting that long of the gold mining stocks. I own them. I had sold a bunch of the NUGT several months ago. Glad I did. Now I'm flirting with it again. So I'm warming up to it. The fact that the dollar's so strong and these gold stocks aren't going down, I got to tell you, it's heartwarming. It's heartwarming because I've been trading gold stocks since 2015, and this is a new phenomenon. So very interesting stuff. I would also be careful of the geopolitical events out there. If the Middle East dies down, that could see a pullback in gold and the gold stocks. So I'm not an overt nasty bull on these names yet. I want a dollar cost average in. That goes for gold as well. Dollar cost average in. F and Meta, if time. Okay, F is, I think it traded down below $10 for the first time since the crisis. I would be careful there. We'll go over them though. There you go. Me too. That's an art. Uh, yes, I own it. That's what we're short of the SQQ with is the SQQQ. We got rid of our long options trade 2 weeks ago, so we still have the SQQQ. TLT. All right, we're going to leave it off with Jeff's TLT. We're already way over. Let's get to it, and we'll rip through these. Hey, Jeff. All right. Apple, first up. Is Apple a short? Not in front of earnings. No, it's not a short in front of earnings. I would wait. I would trade the earnings. If they gap Apple up to 174.19 on earnings, I would probably, depending upon their forward-looking guidance and the quality of their earnings, short it. If it's an unblemished earnings report, meaning they beat top line, bottom line, forward-looking guidance, I might take a pause there, see if we can get up to 177.40, then short it there. But I do believe the path of least resistance for Apple is to the downside. They have no new products. So I'm not excited about Apple whatsoever. Net to me, it's a short. It's just a matter of when. It depends upon their earnings. Don't get suckered in to go shorting Apple in advance of earnings. Bad play. You're going to be shorting into, I'll illustrate it to you this way. Here, you're going to be doing this. You're going to be shorting closer to the lower band of support than what you are the upper band of resistance. That's not a way to short a stock. You want to wait for the counter trend rally, then lean into that rally. That way, you know you have a stop loss point immediately above. It breaks out, you stop out with a small loss. Simple as that. It's all about your risk reward. So risk reward, not favorable to a short in front of earnings here. QQQ, same deal here. QQQ is in a downtrend, undeniable. The problem is that we're right at the lower band. It technically broke down below it last week on a weekly time frame, broke down below it. I think that they pop it up higher this week. And you definitely don't want to go leaning into the short side on that pop because I think that you could get a rally here. Again, we're going into November. Let's talk about this for a moment. Folks, we're using TrendSpider. If you want seasonality, this tool comes with every single membership, link below. You're going to get a minimum of 35% discount using my discount code. Use the link below, and you may get more when you go to their website. Use the link below. So as we go into November, there's a 75% historical probability that we trade measurably higher in QQQ. Now, that didn't hold up for October. But what does that mean? Is that you could see some fund managers playing catch up into the year end, buying the Qs, trying to play catch up so they could do window dressing for the end of the quarter. So you may see an aggressive rally here on the triple Qs. I would not short them. I think that they could go higher. In fact, I may be taking the SQQQ off the table as soon as tomorrow, depending upon tomorrow's close. Now, if we break down to new lower lows, I'm going to remain long. I'm not going to lean into the short, though. XLE. We closed right at the lower band of this fractal trend line. I'm not a short here yet. Not with oil, which moved higher last week. And they usually trade in tandem. Actually moved up on Friday. It was down on the week. So if you take a look at Friday's price action, it was up. So forgive me, I was inaccurate there. And the XLE broke down. So I'm torn here. I would not short XLE yet. I would watch to the end of the week. If we see oil roll over and break down, and we break down on XLE down below, let's call it $84.28. We close down below that mark with oil breaking down as well. XLE becomes a short. But oil's got to be breaking down. If oil's breaking out, XLE is not going to continue going down aggressively, especially if the equity market is rallying as well. So that's a horrible short. Do not do it. Oil needs to be dropping as well. VGT, Vanguard Infotech. Weekly view, not looking good here. I like support down here at this support level at 385.55. That's where I think we're going. There is some support here at 391.90. I like 385.55 better. Daily view. It closed at a daily support level on Friday. You may get a rally here up and into these moving averages, 9 period, 21 period. If you can get up to here, 414 spot 78, I might consider short into that. If we close above it, I would exit that short. So that would be a trade, very low risk, very, very high reward. Devo. Whatever happened to Devo? For you older folks out there like me, Devo, great band from the 80s. I think it was DEVO, how they spelled their name. Devo. Amplify CWD, enhanced dividend income. What is it yielding? I have a watch list that's I'm watching out for divvy players. Over 4.5% yielder. Nice. Beaten up. Okay. Oh, okay. Here we go. That's right. I swear to God, Sean, you must have read my mind. I was thinking Devo in my head. Crack that whip. I was going to say it. I was actually going to sing it. And I said, you know what? Don't humiliate yourself. So it's so funny you just said that. Thank you, Sean. Have a great night, pal. Talk to you tomorrow. Yeah, Devo was great. Devo, whip it. Yeah, whip it good. Yeah. They outgrew their hats. Right. Yeah. Yeah, they were great. Okay. A little walk down memory lane. All right. So I'm not a buyer here yet. I think that we could go lower. I think that the time to buy these names, Annaly, high dividend payers, are going to be when, let's go back to the CME watch tool for a moment. When you start seeing a rate cut build in probability and become competitive with a pause on rates, I think that you're going to see these names rally and rally big, because you're going to have hedge funds saying, okay, Fed's getting ready to cut here. Market is pricing it in. I got to start buying these beaten up names right now, if that makes sense. Annaly right now is borderline 20% dividend payer. I'm going to be buying it. Dollar cost averaging in, though. But ultimately, there's going to be a good time to buy this. Not quite yet. I think we head down to 33.23 on Devo. As a matter of fact, let me add this to my watch list. I can't type tonight. DIVO. There we go. Okay. Moving on. SCHO. Schwab short-term U.S. Treasury ETF. Bullish. I think treasuries are going up higher. This is validating it. We broke out last week. I'm a buyer of treasuries. If the markets sell off, the equity market sells off, money's going to find its way most definitely into, and when I say sell off, I mean aggressive sell off. It'll find its way into bonds eventually. It hasn't been the case for a while. Why? Because yields are going up higher. But right now, I'm bullish on bonds, at least in the short term. So bullish here on treasuries. Ford. Yeah, it closed down below a 10 handle. There's something wrong here. I mean, it's very, very beaten up. Let's go to a monthly chart. We're going to $9.65. That's where we're going. The question is, do we hold that? Daily view. Wow. They must have reported. We're probably going to rally here. $9.62 is the first line in the sand. Let's go to a 4-hour view. Four-hour time frame. We closed at one support level. I still think we press lower here. Again, $9.66. Let's bring up RSI. I already have it up. Daily view I want. I would avoid this. I think that we're going to go down below. You have some high-quality companies right now that are trading with RSI down below 20. UPS, several other ones. I went over them yesterday on our live stream. It's on YouTube. Go check it out. I think that this is going to visit that club. I would not be a buyer here, even at that $9.66 mark. I think that we may defend it, but I think ultimately it gets broken. It moves down lower and probably measurably lower. I would avoid this, revisit it next week. Midweek, late next week. See if it bounces. Meta. All right, so Meta is doing what we expect. We're long of Meta, by the way. We bought some Meta after earnings when it was getting beat up. So we're up on it slightly, not big. I thought it was going to hold 300. It didn't. It broke 300, and we added more right down in here somewhere. So we're bounced back. We're going to probably retest. I can't see it not testing 300. If it doesn't close the week out above 300, I'm gonna get out of the trade. And if the overall market begins to roll over, I'm probably going to short Meta. But it's got to close below 300 weekly time frame, and the Q's got to be rolling over as well. If it closes above 300, do not short Meta. If anything, it then becomes a buy, especially with QQQ moving up higher. So that's the tail of the tape on Meta. I own it. Don't plan on selling it yet, but I may be bailing on it if we fail to close above 300 this week. TLT, same thing here as with the Schwab fund. This is a daily chart. I didn't go over the daily chart with the Schwab fund. We could do that here on a daily chart. Same deal. We are consolidating within a descending wedge formation. I think that we're breaking out on the TLT, and we are moving up higher, especially if the 10-year yield breaks down. All right, so breakdown on 10-year yield, rally in bonds. And that's the tail of the tape, folks. That's all there was for the week that, or the day that was Sunday, the year of our Lord, the October 29th, the year of our Lord, 2023. Everybody have an awesome remainder of your Sunday night. Have a profitable trading week. Thanks for being here. Like, subscribe. You know the deal. I'll talk to you soon. Be well.